Hi, I'm Steve Douglas. Thanks for joining us today. We're going to talk about some very important issues. We're talking about Australian expat tax considerations and also giving you an update on the Australian property market. Now these two things are incredibly linked because as an expat, everyone's usually pretty obsessed with the Australian property market, and in fact it's literally your only taxable activity in Australia if you are living overseas. So the two are intertwined. I hope you enjoy the session and let's get stuck into it now. The big question I wanted to answer for you today is property still tax effective? Now years ago I wrote the book, The Australian Expat, the Luckiest Person on Earth, where we talk about the advantages of buying property as an expatriate, and they are quite profound. But over those 10, 20 years since I wrote it, has things still stayed positive for the expatriate? And I'm glad to say to you, I think it has. And the reasons for that include the fact that negative gearing is still very, very tax effective, especially for an expat. Now, negative gearing is simply the practice where your rent is not enough to cover your ownership expenses and your interest on the property. So what happens is you end up with an annual loss. Now, if you were in Australia, that loss would be used to reduce the tax on your salary, get you a nice little tax refund, perhaps you could use for Christmas, and everything would be great. But when you're overseas as an expat, sadly, you will not get a tax refund each year if you make losses on your rental property. Now, the reason for that isn't bad, it's because you haven't paid any tax to get back yet. But what does happen is any loss you do create carries forward to the next year and then builds up again the year after and keeps building and building and building every year you're away, and is sitting there waiting available for when you eventually come back to Australia and you build up a nest of what we call tax credits that will reduce salary, investment, business income when you start once again living in Australia. Now this is a huge advantage that if you are going to be away for a reasonable period, you can take advantage to build up sufficient tax credits to give yourself a nice little tax honeymoon on return. Maybe 3 months, 6 months, a year, maybe a couple of years. But the biggest complaint we get from our clients is that they say, why didn't you make me build up more of these tax credits? Because they use them very quickly on return. But the big advantage there is all you have to do is buy a property, rent it out, take a mortgage, slow down your repayments and build these tax credits, and I'll show you how that works shortly. In the same way, you can further enhance the build-up of those tax credits by buying property that has depreciation allowances on it. Now there's two types of depreciation. One is on the general fixtures and fittings in the house, the carpet, the fridge, the appliances, and the other is on the construction cost. Now the ATO recently took away the ability to get depreciation claims on fixtures, fittings, appliances if you buy an established property. You can only get it if you're the first buyer from a developer, or you do the renovation. However, if you do buy that, it's going to mean that you don't get the deduction on that, but it's still worthwhile overall, as you see. But you can also get it if you buy brand new, the depreciation is significantly higher. Now, the other thing that you can claim is the original construction cost. So even if you can't claim the fixtures and fittings, when you go back and say, when was that property built? If it was after 1995, whatever the original cost of construction was, you can still claim for up to 40 years or 2.5% a year. Now that does carry from owner to owner. So if you're buying an established property, make sure you find out what was that construction cost by either getting it from the previous owner from their tax return, if it was rented out, or getting a quantity surveyor to give you a report. Very, very important. But that can really boost up your tax losses and accelerate the growth of those so that it's an even nicer little nest egg when you come home. One of the biggest things that I beg our clients to do and have had great success with over the 30 years we've been doing this is try and buy your future home as early as humanly possible. Now obviously you need to hopefully know where that intends to be, whether it's in Sydney or Melbourne, and bear in mind you might change your mind over time and you don't know whether you need a 1-bedroom apartment or a 5-bedroom house. Things can change in your circumstances. But anything you're looking to buy ideally should be something you could potentially live in. And you should never shirk at the urge to buy the better home that is where you want to be, rather than just any old investment property. You need somewhere to live, you don't need an investment property. And the sooner you buy that future home, the better off you are, the more flexible you become, and the stronger you can be at your next investment property. And one of the key reasons for that is you get to buy it at today's price, not tomorrow's. Now, so we've been doing this for almost 30 years, and the property prices have continually gone up at a reasonable pace with only a couple of years of redress. Now that means that if you had bought 10 years ago, you're in a much, much better property at a better price than if you went and bought it today. In fact, many people throughout Australia, expats as well as locals, if you ask them, could they afford their property if they paid today's price? The answer would probably be no, because it's lucky they bought it 5 years, 10 years, 15 years ago. But the sooner you stop that price getting away from you and you have it fixed, then you know that one, you've got the property you want, and two, you also know how much you need to hopefully be low debt, no debt when you come home. It's not going to get any more expensive, so all of your hard-earned savings can be used to debt reduction when you go home. It's a very important element, especially at the moment, as you'll see, with a very, very strong property market in Australia. One of the issues a lot of expats face, and so many don't even realise, is that the rules were changed a couple of years ago to say that if you lived in Australia prior to your departure in your lovely home, normally when you sell your property that you've lived in Australia, you do not pay capital gains tax for the period that you've lived in it, and potentially up to 6 years of rental. However, they changed the rules a few years ago to say that if you sell that property that you've lived in while you are living overseas, it will not have any tax-free component. Now that's critical, because you might have lived in it for 20 years and you move overseas for 2 months and think, hey, I'll sell my property. That selling it whilst overseas means the whole 20 years becomes taxable. Now a lot of expats think, hey, I'll sell my house and I'll upgrade it, find a replacement. But doing that could trigger capital gains tax that is unwarranted. Now, to stop that happening, all you have to do is make sure that you do not sell the property until you're back living in Australia. You don't have to move back into the same house. You just have to have returned to live permanently in Australia. So it's critical that you do not sell a former home whilst you're overseas without checking what that tax cost could be. You could be in for a nasty surprise, and if you've signed the documents, it'll be too late to cancel the contract. So it's critical that please do not sell a former home unless you've got good advice to check what the circumstances would be. Now, instead of selling it, if you do want to upgrade to your next home, have a look how much equity you've got in that home, because it may be that it's easier and cheaper to use the house as a deposit against your next purchase rather than selling to release the cash for a deposit. And if you do that, you get the best of both worlds. You get to keep your home that will hopefully appreciate the longer you keep it, and when you sell it when you go home, all of the gains while you're in Australia plus the gains whilst you've been overseas will both be tax-free if you sell it whilst in Australia back living again. Critical that you do that. Probably the most important thing for all expats to remember. Now, it doesn't matter if you never lived in that property, the rules don't apply. But if you've ever lived in that property, be very, very careful and seek professional advice. The other thing that gets, whilst you're overseas is, sadly, in 2012, they took away the ability for us to get the capital gains tax 50% discount on assets. So what that means is if you're living overseas, you do not get that 50% entitlement, and they reduce it on a pro rata basis in essence. So what happens is the period of time overseas since 2012, no tax-free period. The longer you therefore go back home and don't sell the property, the higher and higher pro rata will become tax-free. Now you'll never get back to the full 50% tax-free, but every year you're back in Australia, you'll get a little bit more tax-free, a little bit more tax-free, a little bit more. So you are encouraged to keep hold of your assets as long as possible now and whilst you're in Australia to reduce the potential tax at some stage. Selling whilst you're overseas is highly likely to be not that tax effective, so you don't want to be looking to liquidate Australian property if living overseas unless you have taken quality advice to check out what would the tax consequence be. And of course, what has happened for expats in particular and foreign residents alike, it's harder and harder to get a loan. Now, when we started our business 30 years ago, we could get a loan for anybody. Now, there's only a few banks that will lend to expatriates, so make sure you're getting quality advice. At SMATS, we are the leading experts on that. We've been winning awards for it for ages. So if you need help with finance, talk to our team, because that's going to obviously determine what you can do in the future. Without the loan, very few of us can afford the property. And also what has happened in the last few years is that land tax is now becoming a big issue in regards to property ownership. You know, when you're living overseas, you pay land tax. If you're renting the property out, it's becoming more and more and more expensive as the state governments have snuck the prices up. One of the reasons I've been able to get away with that is because people in Australia that live in their home don't pay land tax. So they don't even know what's going on. But behind the scenes, the state governments have been elevating the taxable value of your property. Now, normally with land tax, you get paid, it's charged on the unimproved value of the property, not the market value. So it's not what your property is worth, it's theoretically what the land is worth if there was no building upon it. But they have been pushing those prices up higher and higher every year, and some people are getting smashed for tax on a regular basis. Now, one of the things that has also happened is that each state government is starting to introduce foreign surcharges on property, both at purchase time and also on land tax. And if you are a foreigner, you're being hit with a highly additional amount of 2 to 4% as land tax each and every year. Now, generally speaking, expats aren't foreigners, but there is some issues that we need to face because a lot of expats are not sure which they are. So to help you with that, I thought I'd give you a quick review of what the circumstances are in regards to foreign buyer things. Now, importantly, the first thing to note is that you are not a foreigner if the government, if you hold an Australian citizenship or you have a PR visa. So you are not a foreigner for FIRB or government purchases. So you don't need any concessions, any permissions or anything if you are an Australian citizen. However, each state does have different rules, and New South Wales is the most troublesome. New South Wales will only class you as not a foreigner if you are an Australian citizen, or if you do have a PR visa, they won't only if you've been in Australia 200 days in the last year. Now, for expats living abroad, that's obviously not possible. And where we're seeing a lot of problems here is we have a lot of expat clients that are indeed citizens, but they might marry a foreigner, when they're living overseas. They go to a country, fall in love, get married. And of course, as you do, you go and buy a property in joint names, happily ever after. But what's happened is if you bought in New South Wales, that's now become a major problem if your spouse doesn't have Australian citizenship, which is very hard to arrange if you're living overseas. And in New South Wales, not only will they charge you more land tax, but they also charge you more buyer fee. Now, you can see it's 8%. So if you innocently went and bought a property and said, hey, I'll put it in mine and my wife's name, and your wife did not have her citizenship, on her half, she would have to pay an extra 8% purchase price just because she was not a citizen. So you want to be very, very careful not to do that and be hit with a larger cost. Now, you can wait until such time as you move down to Australia, buy it in your name only at this stage, and then when you move to Australia in the future, transfer half to your spouse, and as long as she's been in Australia more than 200 days and has a PR visa or has got her citizenship, there would be no cost to transfer it to her under current rules. No cost for land tax, no cost for stamp duty, no cost for capital gains tax. So that's what you should do. If you are a citizen buying in New South Wales, do not buy it in your spouse's name. Everywhere else, a PR visa is considered to be a local, as is a citizen. It's only New South Wales that has those weird rules. So as long as your spouse has PR, there are no problems. You're not going to have to worry about applying for FIRB, or you're going to have to worry about paying these foreign surcharges. Now, many expats mistakenly think that just because they live overseas that they're a foreigner. That is not the case as long as you are indeed a citizen and or a PR visa everywhere except New South Wales. But you will pay normal stamp duty, and this is getting more and more expensive every year. Now, depending on which state, the rates are different. But as a general rule of thumb, even though it starts cheap from 1.4 to 6.5, it's usually an average of about 5% when you buy a property, plus, if applicable, and hopefully not, the foreign buyer's fees. But 5% when you get in the property, that's it. Now, the other thing that's happening is you can see the land tax thresholds have been put in place, but the land tax values have been pushed up and pushed up regularly. So now, even though the land tax kicks in at $1 million value in New South Wales, if you have a decent house in New South Wales, it's highly likely you will probably be over that threshold and start to pay land tax. Again, there's a surcharge if you're a foreigner. Hopefully you haven't got your spouse on there. And they've just increased that recently to 5% of the unimproved value. So you can see, if you had $1 million value, that would be $50,000 a year if you're a PR rather than a citizen. So you've got to be very, very careful if you're buying in New South Wales and you're not an Australian citizen. Hopefully these things don't apply to you, but be mindful, particularly if you have a spouse that is not an Australian citizen, that may or may not have their PR, make sure you're aware of it. But what this is all showing you is that the government is making it harder and harder and less cost effective for foreign investors to come in the market, which is madness because we need those investors to keep our property market fluid and available and growing. But they don't seem to think so. Now, what is happening here is I'm going to give you an example that if we went and bought a property in Australia as an expatriate, and in this case, I'm going to borrow 70%. So you're living overseas, you think, hey, I think I should buy a property, maybe your future home, hopefully, maybe just investment, whatever, it doesn't matter. But we're going to go borrow on $1 million property, 70% finance at 6.34, roughly the current rate as at time of filming. Now you can see here, we're going to have about $50,000 rent on the property. And then all of our expenses, including the interest on the $700,000 loan, of 44, our total costs are $58,000 a year. Our income is 50, so we have that negative gearing going on. We've got an $8,000 negative cost of ownership. That is negative gearing, and very simply, that just means we don't have to pay any income tax. Now that's a good thing because your starting tax rate as an expatriate is from your very first dollar of income. A lot of expats think that they still get a tax-free threshold like they would if you were living in Australia. That is not the case. When you're living overseas, there is no tax-free allowance in Australia whatsoever. So if we were in $1 of profit, we'd start paying tax at the rate of 30 cents on the dollar. But because we've got a negative here, there is no tax payable. Negative means zero. 0 times 30% is still zero. Now this $8,000 would accumulate each year into the future. Next year it becomes 16, 24, etc., and would be available to offset any future rent, capital gains, or Australian income when you move back. But you can see the advantage. If we bought a new property, we can increase that $8,000 tax loss with non-cash outlays such as the building depreciation, which on $1 million brand new property would be about a $450,000 construction cost on average. So that would give us an $11,000 tax deduction that you didn't have to pay for each year because it was in the purchase price. It's an automatic thing you get every year in your tax return without having to write out a check. And because it's brand new in this case, we get the depreciation on the fittings and the carpets and the appliances. Now, if we had bought this from someone else as an established property in the second-hand market, we would not get that $3,750 depreciation. Now, mark my words, it's not enough reason to buy brand new just for the sake of it, but certainly if everything was equal and the brand new property was just as nice as the second-hand one, you might as well get the tax incentives rather than just buy the one and not get as big a deduction. But you can see here, the $8,000 holding cost now balloons out to a $24,000 tax deduction, which will offset any other income you have. Now, if you had a second property that you may have bought years ago and is now profitable, this loss could offset that rental and nullify your tax. Now, if you didn't, it would just carry forward each and every year. 24 would become 48, 62, etc., and you just keep building and building this tax loss every year. Now, importantly, we don't want to lose money when we're investing. That's not an objective. So the great thing about negative gearing is that it is tax effective, but we do it on the proviso that we can recover this holding cost back through future gains. If you do not believe that the property can give you this money back as a growth amount, do not buy the property. Trust me, just about any property can achieve that, so you want to make sure yours does, but the more it can grow, the better off. Now, the break even in this particular situation would be approximately 1% growth. So $8,000 divided by $1 million is about 1%. So we need that property every year to go up by about 1% a year just to make it worth our while. Everything above 1% is clear profit. Everything below 1% is making our loss worse. We don't want to have our loss worse. We're doing this to be a profitable investor, and we want to be tax effective at the same time. So that's the thing to do. Now, if we were a foreigner, or if you had yours PR, then the only difference would be that our rates and taxes would have that extra cost of land tax, which in this case may be in the order of $6,000, depending on the type of property. Obviously, a house will have a bigger land tax cost than an apartment, etc. But in this situation, it would take our break-even cost from 0.9 to 1.47. So you just have to be mindful of that as an extra cost, if applicable. But a reminder, you're only paying the foreign surcharges, if you are not an Australian citizen or a permanent resident visa holder, or in New South Wales, even if you are a permanent resident visa holder, but you're not living in Australia for more than 200 days in the last 365. But this is a nice way of building up what we call tax credits, because this $24,000 will carry forward to offset future rental if the property ever becomes more rent than expense, future capital gains if you sell the property whilst you're living overseas, but more particularly, future salary on return to Australia. And that can be quite substantial and worth to you between 30 and 47 cents in the dollar in the future sometime. Very nice build up, very good thing to do whilst you're overseas. The longer you are, the more this can be. You can't build it up quickly, but you can build it up with time. Now, just to give you an idea of if that makes sense though. So what I've got here is a tax analysis of what if we paid cash, what if we borrowed half, what if we borrowed the 70%. And you may even be able to push it to 80%, or if you have equity in another property, you could borrow potentially 100% if your total property values and your loan did not exceed 70%. So have a look at that. But you can see here, and I won't go through in great detail, but if we pay cash, we're going to pay a little bit of income tax each year to the tune of $30,000, where we pay no income tax if we borrow half or 70%. But at the 50%, we're not building up any of those future tax benefits. So we've got no protection against capital gains, in this case when we sell, or future salary later on. But what is happening here is that we've put in less money, if we borrow than if we paid cash. But assuming the property grew at 6% value, and if we sold it in 6 years' time, that $1 million property plus costs would now be worth about 1.3. Now, if we sold, we would have to pay capital gains tax. And you can see by not having any debt, not having any build-up of losses, the capital gains tax is substantially more if we don't have those losses to protect us than if we do. So it goes from $137,000 if we paid cash down to $82,000 if we had used sensible amount of borrowing. Now, our return on investment after tax therefore goes from 5.6% if we pay cash, and that's the money that we contribute at the start, the money we contribute on the way to hold the property, less the sale proceeds, is an internal rate of return of 5.6% after tax if we paid cash, and lifts to 7.5% after tax if we had borrowed money. So ironically, by borrowing money and helping our tax scenario, we've lifted our overall return by almost 2%. So it's very, very cost effective to use debt. And as a result, you should want to reduce your debt as slowly as possible whilst an expat. Now, that's particularly true if this was going to be your future home, because you don't want to pay it off until such time as you move in. But one of the key advantages, as I mentioned earlier, is having today's price rather than tomorrow's. If this was going to be your future home and you bought it for $1 million today, the great thing is when you go home in 5 years, you're not going to sell it, you're going to move in, but you're moving into a house worth $1.3 million that you only paid $1 million for. That means, importantly, your mortgage is still at $700,000, whereas if you were buying it now, you'd have to borrow another $300,000 potentially. So what happens is all of your savings can go to reduce that $700,000 loan rather than go towards paying extra for the same house if you buy now rather than tomorrow. And that can be a big difference in helping you get closer and closer to the ideal situation, which is zero debt on your family home on return. Now, one other thing I'll mention is that if you were going to buy a couple of properties, one of them may be your future home, the next one is an investment, the bank may require you to put cash in along the way. If you were going to buy an investment property with just cash and had to put cash in, you'd be better to put that cash in as a deposit and reduce your future home loan and then draw it back so you borrow more on your investment property and have less debt on your future home. So when you go home, once again, there's less to repay. It's critical that we do that. We'll help you through that at the time. But the key is reduce your future home mortgage, not your investment property loans along the way. Now, just a quick one, if we look at the same property, but if we put the overlay of being a foreigner on it, with those extra duties, you can see the difference is that our purchase price is higher because of the additional stamp duty, the additional FIRB fees, and as a result, our after-tax return when we sell the same property for the same price, but with higher costs, we've only ended up with a 2.8% after-tax return rather than a 7.5% as Australian citizen. Now you can see at 2.8, not very many investors, foreign investors, are motivated to buy. So if your partner is considered to be a foreigner, be careful. Now you can see we are needing the property to grow as much as possible, and just to show you sensitivity, this is based on a 6% growth. If we were lucky enough to achieve 8% growth by picking a better property, buying in a better area, doing whatever, then 8% would equate out to a 10.3% after-tax return. So we lift the return almost 3%, even though we've only achieved 2% more growth. So the more growth, the better, the more leveraging, the better. And what that means is buy now, get in there with the debt, keep the debt, use the debt as a tax deduction, build up some losses, and hopefully buy a better property, and see how it goes for you in the future. Okay? And you can see for a foreigner, they need the higher return because it's the only way they're getting towards a reasonable rate of return overall. But how achievable is it to get that 6% growth or more? Well, you see here, these are the current numbers, and throughout Australia, we're doing pretty much everywhere is doing above that 6%, except for currently Melbourne. Now, the key reason Melbourne is not doing that is purely because during COVID, they had an exodus of their students, and they've only just started coming back. So they've had a delayed progress and kickoff after COVID because they were waiting for those students to come back. That's only just happening, and they're now seeing pressure in the market now through supply and availability. But particularly Brisbane, Adelaide, Perth have been having a real sweet patch, 15, 15 and 24% respectively. But Perth and Brisbane are coming off quite a period of slumber. They haven't really made much growth in the last few years. So this is a little bit of recovery profit, but it's also showing that the pressures in the market are starting to be very, very real and very, very powerful, and are changing the market differently to what we've ever seen in the past. And I've put down some of the key reasons as to what's driving the Australian property market in particular along the bottom. And the most powerful one is our population growth. We have the highest population growth in the Western world because it's the nicest place to live. It's the safest, it's furthest away from all the commotion the rest of the world is experiencing. And so we've had very strong population growth that I'll show you in a minute. And particularly what we've got is population growth from migration as well as from natural births, And what that is that we're seeing people now looking for housing later in life, because a lot of people these days have delayed the decision to have children much later than historically. Previously, it was not uncommon to have your children at 20s. Now it's happening in 30s and sometimes even 40s. Now, where that becomes an advantage for your late life upsizers, as I call them, is that usually if you're buying a house at 30 or 40, you're more financially astute than if you're buying it at 20 or 25. So they are buying the houses they want. They have the financial capability to do so because they haven't had the cost of children early. They've been saving up while they go. We're also seeing strong migration, record levels, and also a strong level of expats returning, particularly through COVID, but they're hanging around. And we used to have 1 million expats overseas. I think that's dropped down, in my view, to probably about 750 to 850 now. So significant have come back, including myself, after a while. And then we're seeing, the baby boomers downsizing like we've never seen before. And this is particularly strong in Sydney, where a lot of people are selling their houses at prices they cannot believe, and then heading up to places like Sunshine Coast, Gold Coast, Byron Bay, cashed up, pushing prices up because they're cash buyers and getting whatever they want at whatever price they need to pay, and making the market strengthen really, really fast. And that's not going to slow down because there's a lot of baby boomers in Australia. It's also helping their kids, where they're giving them deposits, all sorts of things. So it's changed the market like nothing else has happened in the past. And this, to me, will stay a dominant factor for the next little while. And then one of the other things that a lot of people forget is that divorce is pushing the property market up a lot as well as. And one of the reasons for that is we go from it needing 1 unit of accommodation when we're a happy family to 2 units of accommodation if we get divorced. Now, okay, there's a smash there from the fact we sell the house, one person gets it, but the other person needs it. So it's going to make the pressure on the market stay strong, because sadly, in our Western society, almost half of people are getting divorced these days at some stage, and this has an insurmountable effect on the property market throughout. But we're also seeing people richer and richer than they've ever been before through the release of their house when they sell as baby boomers, which if they've been living in is all tax-free, through the fact that we have one of the highest average weekly earnings in Australia, through the fact we're seeing inheritance come through. So there's a number of reasons pushing affluence in Australia, and they're not going to subside anytime soon. And then of course we've got a situation where we've got long-term undersupply in the market that simply cannot catch up to demand. Demand from natural migration, demand from natural births, demand from market movement. All these forces cannot keep supply up, and the governments have not been good at helping the property market and achieve stock. And of course, if you've lived overseas, the one thing I often tell people is you've been given the keys to a time machine, because normally anywhere else in the world that you live that is a established Western community, Australia is a bargain compared to where you're living. If you're in New York, Singapore, Hong Kong, Dubai even, Australian like for like, similar for similar, equal location, Australia tends to be much, much cheaper in my view than any other place in the world. And if you're wise enough, think about the most expensive place in the country you're expatting that you think is the best, and go replicate that back in Australia, because that's where the prices will head in the future. Now, again, if you're in Hong Kong, you don't get a lot of money, a lot of property for a hell of a lot of money in Hong Kong. So when you sell it, you can't believe your luck when you go to Australia and they're a fraction of the price. In Singapore, same. And at the moment, the Australian dollar is also cheap, which means that if they do bring cash, they're getting more bang for their buck too. So all of these factors combine to, I think, create perhaps the longest period of sustainable outperformance that I've seen in my 30 years being a property tax advisor. So don't be left on the sidelines. Now you can see here in terms of what's happened is during COVID we did see a little bit of a softening of the Australian property market, mainly out of the fear factor of what would happen. Now at this time I think we were the only people that said, hey, go buy a property, this is a good thing for property market, and sure enough prices went up. Now that was largely attributed to the fact that interest rates went down, so affordability came in, but it was also the fact that Australia, being a genuine lifestyle destination, always does well in a global crisis, whether it was the GFC, SARS, COVID. Whenever things go wrong in the rest of the world, Australian property does well because it's the nicest place in the world to live. Now we have seen prices cool off a bit, and this chart shows annual or quarterly growth on quarter. So from the record highs of 6s, it came down and did lose a little bit, but I don't think the property values went down, but the pace of growth slowed. And what happened was people weren't selling their property because they couldn't get it. And that was because interest rates went up very, very rapidly after falling rapidly. Now, interest rates haven't risen, they've returned to normal. But at this time here, there was a lot of fear and speculation saying rates have skyrocketed. They hadn't skyrocketed, they returned to normal. Once people figured that out, you can see we've returned back to stable growth at a much more sensible level per quarter. But as you can see, in most markets, we've got past the peaks of COVID, and I think this is still early days. There's a lot more growth to still occur in the future of Australia. Now, one of the reasons I think that is because normally when a market is booming, you can sort of sit on the sidelines and procrastinate for a while, and you can say, oh, look, I'll just rent for a while and then I'll buy later when prices calm down. The problem in Australia right now is there's very little rental supply. So you haven't got the safe haven of hiding in rental for a while, waiting for things to get normal. There's literally no rentals about. So you better go buy a property to live in. At the same time, there's hardly any new stock coming into the market. The only real way you can improve the market overall and make it more affordable is to introduce new supply, but more particularly, supply of the stock that people want. Now the problem is the supply that's coming in isn't necessarily in the places people want to live or the style that they want to live. So we're not seeing pressure relieved in the better suburbs, but there's still cheap, affordable housing if you're willing to go out to the areas. And the building industry at the moment is not doing very well overall. Again, the governments have not helped them out. They've not looked after them. They put pressure on during COVID where they gave an incentive for anyone to build a house, and they all took in deposits, and they're struggling to deliver stock, struggling to survive cash flow. And we're seeing quite a lot of builders, from pressure, from mismanagement, a combination of the both, fall over, which is going to mean it's even harder to bring supply in. Excuse me. And then we also have the governments very, very greedily taking the money and not doing changes that are going to improve the market. Now, in particular, I'm referring to land tax and stamp duty, where the money is just raking in. And then you throw in the extra one of GST. When you buy a property in Australia that is brand new, there is GST charged inside the purchase price, about 6-7%. And that includes when you're throwing on the purchase price of stamp duty, another 5%. And then if you're a foreigner, another 7 or 8%. So the governments are absolutely raking in billions of dollars across Australia from these surcharges and entry charges. And they're talking about how do we make the market affordable, but they're not acting to make stamp duty less, to make GST removed on brand new, or stop the double dipping. To me, why wouldn't you say, okay, if we're going to get 6% GST, let's not charge 5% stamp duty on a new purchase. We'll do it only on established, because they don't need both, but they are taking both. And it's huge money and it's problematic, but no one wants to address it because too much money is being raised. And then we're not going to see them change that anytime soon because they're pretty happy with it. And if we have a look at interest rates, they certainly cooled the market because people were worried and they got used to cheap rates. But now that everybody's got used to it and realised that we're back in the normal range, natural forces, real forces are taking precedence and pushing prices up. Now here is the big factor, and this is population growth, and you can see Australia grew at 2.5% population, the highest ever. And that was a little bit of a COVID kick, particularly in Victoria, where a lot of students left and have now come back. But places like WA, which is now at 3.3% population growth, the highest in the Western world, that is dominant force that is pushing prices up. New South Wales 2.3, Victoria 2.9, Queensland 2.7. These are huge numbers compared to the historical averages, and there's no real sign of it letting up. And in fact, we've hit new records. And not only have we hit new trendline records, but the percentages are also at record highs. But where that's doubly empowering is the fact that a 2% off a 27 million population base is significantly higher than a 2% of what was a 20 million population base back 10, 15 years ago. So this is not going to let up. I think Australia is going to continue to be the dominant place of choice in the world, and hopefully it'll slow down a bit, but they can't slow it down quick enough because most people with PR that are coming in have had that PR for up to 5 years. So it's a 5-year plan before they can slow it to any extent because the visas have already been issued and these people are on the way. So this will be the dominant force in the Australian property market for the next 3 to 5 years, combined with local activity, etc. What we're seeing there is, and here is the way that you know that we have safety in the market, because if it was a speculative market, if it was an investor market, there would be high risk. But the reason we know that there's not high risk in the Australian property market is because the vacancy is at all-time lows, nationally at 1.5%, which has never really been there. It's down from 3.3% a year ago. Now, Melbourne was at 4.2 a year ago. It's now 2.8. Now, it's the highest in the country, but the reason for that was because all the students left during COVID, but over the last 12 months, they've started flooding back, and you can see they're correcting that vacancy at an alarming rate to the tune where just in the last quarter, that vacancy fell by 0.8%. Now, Brisbane, Perth, Adelaide, its vacancy is less than 1%. There is literally no supply. So you cannot hide, as I mentioned earlier, in a rental. You need to go and purchase in the market, and that's going to keep the market strong. This is the one to keep an eye on in the future if you're worried about risk. But while this is tight and there's limited supply coming on, there is no other natural alternative than for prices to push up. And you can see over the long haul, Australia's been very consistent. Sydney 6.8% over the last 5 years. Melbourne has been an underperformer because of that exodus of students, and also because what we've been warning people even before COVID, in Melbourne they built a lot of we called stops, small, tall and overpriced apartments. So they have been underperforming, selling badly. They weren't worth buying before, they're not worth buying now. But genuine housing, real quality living is the thing that is still in short supply. So there's a split market there. But Brisbane, Perth are certainly out of their slumbers. Adelaide doing well. You know, it's very good all round. And I think this is going to be, for at least the next 3 to 5 years, consistent, reliable growth above average. Now, given that, should you consider buying a property sometime soon? You know, and that really is the tough question, and particularly for an expat. You know, most expats have been looking and saying, oh, I hope prices go down. Should I buy now? I'm worried about it. Can you get a loan, etc.? But you know, I think there's a compelling argument from all that we've discussed as to why you should start looking to get your next property if you can. But the starting point and the hardest point is, can you get the finance to help you purchase it? And so I would always recommend that you should start right there with your mortgage broker and say, can I get a loan? And again, if you need assistance with that, you know, our team at SMATS can help you. But without getting the approval, you can't go bid at an auction, you can't go buy, and you'll just get frustrated if you find a property you like, want to put a bid in, and then can't get the lending support. So get your loan pre-approved first. That makes you a cash buyer, in essence, in the market, and puts you to the front of the queue at the auctions, the front of the queue at the negotiations, and hopefully it helps you find the property you want quicker and sooner. If you can get a loan, to whatever extent that is, by golly, go buy a property. You know, so if you can, you should. And you know, think of all the reasons. The FX is as good as it's ever been. The price today was going to get, is lower than it will be tomorrow. Excuse me. You'll get the support of the tenant helping you pay it off, and you get all the tax incentives that we talked about. It's never been a better time to be an owner of an Australian property from overseas, even though it's never been a worse time with the cost of land tax and stuff. Now, land tax is a factor that you need to take into consideration, but it's not a disincentive to own. It's just something, damn, I better put that on my budget. Now, particularly if it's your future home, please buy that as early as possible. If you have not bought that yet as an expat, put that high on your priority list ahead of any other investment property. If it's in your price range, if it's in your target zones, if you know roughly where that is, what style it is, the sooner you buy that, the better your finance and your future will be, because you'll have certainty of planning and you'll have certainty of entry point back to Australia. Now, that doesn't mean you'll end up living in it. You might upgrade by the time you come, you might relocate, you might have thought you were going to live in Sydney, you end up in Melbourne. But if you've bought it as a potential home, more than likely it's going to outperform the market and do you well. So please put that high on your priority. Now, the other reason I beg people to buy their future home is because what we've seen in Australia over the last 5 years in particular is the property market is split in two between what I call the livable and the rentable. Now, if you're a more desirable property in a more desirable area, near a school, near a beach, near this, near something, it is outperforming the less desirable, I'll live there just because it's all I can afford. And as a result, you don't want to be in that market as an investor. You want to be in the market that's going to give you the best chance of success. So whether it's your future home or whether it's pure investment, buy the best property you can afford, buy the best area you can afford, get your budget worked out and make sure you spend it wisely. And the better, you better like the property, because likelihood is you're not going to like the price. Now, especially if this is your future home and you've got aspirations, a lot of expats freak out because they remember that house they wanted was 1 or 2 million and it's now become 2 or 3 or 4. So sadly, you missed the boat from the previous. Make sure you don't miss it again. If you're hoping it's going to return to the past, that is extremely unlikely, but make sure you find something that you like, and the more you like it, the more chance of success in the future. And what you've got to remember is play the long game, play the quality game. If you do that, you're likely to have great success, come back with a home that you can hopefully move into, pay off the debt that you acquired to buy it with your savings that you've accumulated, and it hasn't got away from you and is worth more than you paid, but hasn't cost you an extra cent. Quality never goes out of style. If you do that, you're always going to be happy. Property has always been a good holder, and Australia is going to have a period of sustained growth, I think, like we've never seen, and I've been doing this for 30 years. So I hope you can get off your tush and find your favourite property, your future home, if you haven't already, and then enjoy yourself as an expatriate, save as much as possible so you can achieve low debt, no debt on return. So in essence, Australian property is still a very tax effective option for an expatriate, and it's still a very profitable opportunity for you as an investor whilst living abroad. I hope you enjoyed that presentation. If you need any assistance or you want to go through your personal situation, contact us. We'd love to help you with your tax, with your finance, with your planning and your repatriation. All the best. Thanks very much.